Imagine getting into, like, an exclusive VIP club where the drinks are 90% off.
Yeah, that sounds pretty nice.
It does. But now imagine the bouncer kicking you out months later and demanding you pay full price for every single drink you ever had.
Yeah, that's a nightmare.
Welcome to today's deep dive. We are unpacking a source article called Texto Pagado to help you understand why Mexico's RESICO tax rate is actually a massive double-edged sword.
It really is. I mean, on the surface, the simplified trust regime RESICO is pitched as this entrepreneurial paradise, you know?
Right, offering what? An incredibly low income tax rate of just 1 to 2.5%.
Exactly. But the Mexican Tax Authority, the SAT, is totally unforgiving about it. If you misstep, it's not just a category change.
No, it's a retroactive financial blow that can just destroy your cash flow, right? Like almost overnight.
Yep, it's brutal.
So how do you actually trigger this bouncer? Looking at the source, there are these hidden landmines that explode before you even realize you made a mistake.
Yeah, the classic one is the partner trap under Article 113E. The rule there is absolute.
Like zero exceptions.
Zero. If you hold even a tiny fractional share in another company, you are legally disqualified. It doesn't matter if that company has been dormant for a decade or if it generates zero profit.
Wow.
The SAT system sees that legal link, and they retroactively expel you to the start of the year, recalculating your taxes up to 35%.
Man, it's like securing an exclusive VIP gym membership, only to be thrown out and charged back dues at a premium rate just because, I don't know, you held a friend's towel once.
That is a perfect way to put it, and the SAT catches this instantly, which brings us to another silent trap, the hourglass of omits.
The hourglass.
Yeah. Their system automatically boots you if you miss 3 monthly payments, and they don't even have to be consecutive, or if you just miss your annual return.
I'm guessing the biggest blind spot for you as a new business owner is the zero income month, right? If I made no money in July, I might naturally assume I don't need to file anything.
Oh, that assumption will get you expelled so fast. The SAT doesn't rely on random human audits for this stuff anymore.
It's all automated.
Entirely. Their system automatically cross-references the digital timestamps on your invoices with your monthly filings. If they spot a gap, even for a zero revenue month, the system kicks you out.
Okay, so their automated systems catch the technicalities.
Yeah.
But let's say your admin is flawless, you file every month, you don't own shares anywhere else, you're completely safe.
Right.
Well,
Oh, not if you're too successful.
wait, what?
Yeah, RESICO has a strict glass ceiling. Your annual income is capped at 3.5 million pesos. But the catch is that this limit is based strictly on collected cash, not profit.
Wait, hold on. Why would succeeding too fast late in the year actually be a catastrophic penalty? I mean, doesn't the SAT want to collect taxes on that money?
Oh, they definitely do, but under a much harsher regime. Let's say you land a huge contract and a client pays you a massive lump sum in December, right?
Okay, sounds great so far.
Well, if that pushes you over that 3.5 million limit, you are immediately ejected for the following month.
Oh, wow.
And the same thing happens if your electronic signature, your e.firma, expires, or if your tax mailbox isn't updated, they just instantly migrate you to the general regime.
And the mass on that migration is just staggering. Let's say you're bringing in 100,000 pesos a month. Under RESICO, at 2.5%, your monthly tax is what, 2,500 pesos?
Yeah, around that. But under the general regime, it jumps to about 20,000 pesos.
So if you suffer a retroactive expulsion in November, you don't just start paying 20,000 in December, right?
Well, the SAT bills you for the previous 10 months.
Hmm.
You suddenly owe 10 months of that 17,500 peso difference all at once, plus penalties.
That's nearly a 200,000 peso bill overnight. That's enough to instantly bankrupt a small operation. So knowing those catastrophic risks are baked in, how do you actually build a defensive shield?
Well, our source highlights a few survival strategies. First, do an audit partnership. You have to proactively check the Public Registry of Commerce, the RPC.
To make sure you aren't unknowingly listed as an active partner somewhere.
Exactly. Clean up those legal loose ends. Second is invoice vigilance. You have to ensure your digital invoice codes perfectly match the actual cash hitting your bank account.
Right, so whether you use a PUE code for an upfront payment or a PPD code for installments, it has to mirror reality.
Yeah, because mismatches are instant red flags for the SAT system. But the final and maybe most counterintuitive strategy is preventative deductions.
Wait, but RESICO calculates tax purely on revenue, so technically you don't need to track deductible expenses, do you?
You don't need them to file, no. But if you get pushed into the general regime, you are suddenly taxed on profit.
Ah, I see.
If you haven't been keeping and validating all your expense receipts, your profit margin looks massive to the SAT, and you get hit with a 35% tax rate on almost your entire gross income.
It's basically packing a parachute for a commercial flight. You hope you never need those deduction receipts, but if the SAT pulls the trap door, they're the only thing saving you from the drop.
That's exactly it. Building that parachute takes time, but it's non-negotiable. RESICO is incredibly lucrative, but it demands intense vigilance.
Basically, you can enjoy the cheap drinks at the VIP club, but you better be watching the bouncer the entire time.
Yeah, pretty much.
So we'll leave you with this to ponder. If a so-called simplified trust system ultimately requires you to maintain complex defensive bookkeeping just in case you are retroactively ejected, does the constant psychological burden of a potential audit actually outweigh the initial tax savings?